Hey guys, good morning. Welcome to my channel Stock Simplified. And here we're going to study on how to invest into companies. People really do not understand what all to look into a company before we invest and to make out profitable rather than multiple times return in a company when we invest. And with this channel, we want to our main motive is to increase the financial literacy of people in terms of all of us know balance sheets, but how to look at the balance sheet, what to look into a company before investing, what all are the companies that we can invest into to get multiple time return, or what are the company, what are those specific points that we can look into a company in which we can know that the probability of us incurring a loss is very less. So let's get started. Before starting this, I want to start with a very simple question, like what do you look into what do you look into before buying a house? Okay, so here we are. Before buying a house, you would first look at the builder's quality. That means the builder's reputation, the kind of business he has been into, the kind of projects that he has delivered, the builder reputation. Does he deliver on time? Second point is the location. Where is your house going to get located? What is going to be, is it near to the metro? What is the mode of transport? You can look at the master plan as well. What is the 10 years down the line master plan? Are there any nearby airports? So before buying a house, even a layman looks into every nuances, intricacies of the fact that even a small detail is taken care of because you're investing your hard-earned money before buying a house. Now, with this example, I wanted to say that before buying a stock, you only take advice. You never do any kind of a research. You only take advice, maybe from your share broker, maybe from a relative, maybe from a friend of yours, and you just invest your hard earned money. That amount may be a lakh or two. People in their early 30s or late 30s invest in the market when they have some excess cash left. So here we are. With this initiative, we want to increase the financial literacy so that you have guns in your hand where you can obliterate a company in terms of its balance sheets. You can know by looking at a company's balance sheet, you can easily say that yes, this is a good, a profitable investment to make, this is not a profitable investment to make. Rather than, I won't say that this is 100% you'll make if you follow my rules, my strategies. I have been investing for the last 10 years, but with my strategies, I minimize my losses to a greater extent. So it will be a combination of strategies. Let's get started. Now, what is the very first thing I would like to say? What is the very first thing that you look into a company? For example, you look into any company. What is the very first thing that you would like to look at? The very first thing that you would like to look at is return on capital employed. Now, this is one of the most important factor that you can look at while looking into a company. Now, what does return on capital employed is? Return on capital employed is the amount of money that you make over borrowed money plus your owned money before taxes. It calculates the percentage of that. So it's a fair, decent ratio to calculate the profitability of a company. We'll go forward with this by an example that is stated on your screen. For example, you have a grocery store. You want to open a grocery store. Okay. You have your own capital of rupees 50. You borrow money from your friend of rupees 10. You take loan from the bank of rupees 30. So your total capital employed becomes summation of 3, which I have done is a summation of 3, that becomes 50 plus 10 plus 30, that is 90. Your profits before tax, that means after excluding all your costs, after excluding all your interest, depreciation, your profit before tax comes out to be 30. Now, to take a money from a friend, let's say the friend charges you an interest of 10%, that is rupees 1. Now the bank charges you interest at 10%, say rupees 3. Now total interest is rupees 4. Profit before tax is 30 rupees. So how do we calculate it? How do we calculate ROC? Your numerator becomes again I'm reiterating, your numerator becomes profit before tax plus interest. That is your numerator, and your numerator becomes profit before tax plus interest. That is rupees 34. This becomes your numerator. Now what does the denominator become? Denominator becomes the total capital employed. So this is a fair enough ratio where you are calculating. See, why am I including the interest? Because I have taken loans and have utilized those loans to get profits. So it will be very feasible for me if I include the interest, because that interest that I'm paying also have helped me generate profits, correct? Now the total capital, what my denominator becomes is, my denominator becomes my owned capital plus my borrowings from friend plus bank, that is 90. So my denominator comes down to be 90. Now if I take a ratio of this two, it becomes my ROC. This is 37%. This is 37.88%. Remember guys, this is a very good ratio when you consider from a company's point of view. 37%. If we will go about analyzing balance sheets, will go about analyzing profit and loss accounts, this kind of ratio of 37.78%, you'll find it in very less companies. Now we'll go forward in on how to, we'll go in a stepwise manner on how to find this ratio while looking at the balance sheet. The very first company that we are going to take is Reliance Industries. It's one of the biggest companies. It is known to all. Let's see how we can get it. How we can get it from the annual report, because a lot of people might be knowing about everything ROC, but it is very difficult when you have to look at the annual report and get the authentic values. So let's move forward. Wait, I'll just open my browser. This is the website that I follow. I open Reliance Industries. Reliance Industries, you scroll down, you go back to the financial report 2019, but not the financial, the annual report, sorry. And in the annual report section, let it open first. In the annual report section, you have to find the balance sheet. Let me just find the balance sheet. Here is the statement of profit and loss. Here I found the balance sheet. Now for the owned money will be in like in the example of a grocery store, the owned money will be equity, share capital and other equity. That comes down to 4,05,322 crores. Okay. So here we'll go down Reliance Industries. The total capital is 4,05,322. What are the borrowings? The borrowings in non-current liabilities, we have the borrowings that is listed here is 1,18,098. We have it here. The short-term borrowings we have 39,000 39,000, if you can really look at it, 39,097. We got it. We have written it here already. Now our denominator becomes the summation of this three. It is 5,62,570. And what is our, now we come to the numerator part to calculate the ROCE as I is explained. Now for the numerator part, we need profit before tax. Profit before tax, we find it in the profit and loss statement. If you can see that here we have profit before tax, here it is. Now 47,367 we have written here. Now we need to include the interest as in stated in our earlier example when we took the example of the grocery store. What is our interest? The finance cost. The finance cost is 9,751, which we have written here. Now the numerator becomes the summation of these two figures. Okay. The summation of these two figures, we get the numerator as 57,118 and the denominator as 5,62,512. Now we we for calculating the ROCE, I numerator versus the denominator. Now I get this return. Now, for a company as big as Reliance, the return on capital employed is 10.15%. Okay. Now, I will not comment as of now that is it a very good uh, rate of capital employed, return on capital employed, or it is a bad return on capital employed. Let's look at another example. We take an example of a company. Reliance Industries was a very big company. We'll take another example of a company known as ITC. ITC is primarily into cigarettes. It has a lot of diversified products into FMCG, then it is into stationery. Let's take another company. Okay. Now coming to ITC, I would again require the balance sheet, the annual report of ITC. I have ITC here on my screen. I scroll down. I go to the financial. I open the annual report. Now I'll have to find the balance sheet again. This may sound a very tedious process at times, but in order to maintain the authenticity of the figures, because at times the figures vary from one website to other website. No doubt a person can take figures from any financial website, which I'm not quoting here. But see, here we got this is notes to accounts, and this is hmm, I'll have to find it. Where has it disappeared? Just let me search. Yeah, I got here. Here it's the balance sheet. I just typed in the search column other equity because other equity is generally present in the owner's capital. Here I have equity and others equity amounting to 57,000. This is the total 57,949. 57,000 total own funds is 57,949. And my borrowings, non-current borrowings, it is 7.89. I have written it as 7.89. Now my denominator becomes the summation of these two figures. That is my denominator. Yeah, the summation of these two figures, that is 57,956. Now I again need the profit before tax, which I again scroll down. I go to the profit and loss statement. Now profit before tax is 18,444. This is 18,444. The finance cost is 34.19. 34.19. Numerator becomes the summation of this plus this. Now to calculate the ROC, just put in the numerator versus the denominator. You get 31.88%, which is a very, very good criteria. While evaluating a company, that means a company, after investing a certain amount of money, which it has taken from its own capital, borrowed from the market, borrowed from the banks, before paying taxes to the government, it has been able to manage a return of 32%. That is huge, huge. So if now one more point that one needs to take into consideration is why is there a difference in the return on capital employed? The first point is return on capital employed. I will talk about the second point, but I just want to make it clear here The only difference that is made here is because of these loans that Reliance has. It has loans amounting to 1.5 lakh crore that I have highlighted on the screen. That has made a significant difference. For example, had these loans not been there, that means this ROCE would have been this divide, sorry, equal to this divided by equal to PBT. That means had there been no interest, it would have been 11.69%. That is an incremental of 2%. But since it has taken huge loans amounting to 1.5 lakh crore, the return on capital employed was less for Reliance. Now the actual return on capital employed was 10.15%, whereas in terms of ITC, its borrowings are very less. It has been able to have a command over its products. So that means the products are more in demand. That means it has a pricing power over its products, and people are ready to pay for it. Now, we understood ROC. ROC, how to calculate from an annual report, we understood that. Now, the very first criteria is how do you evaluate a company in terms of ROC? Here we would take 4 years, past 4 years of any company. The first criteria, I'm reiterating it, the past 4 years of any company. If a company is able to manage ROCE greater than 20%, this will be my first filter while judging a company. The ROCE should be more than 20%. Why I'm taking it as 20%? If I if I deposit my money over in a bank, it gives me a return of 8%, 7, 8, 9%, 8.5% in some cases to senior citizens. Now I'm already risking my money in a business. So I would require a return better than the return of FD via my business. So to get that return, either there is one, I need a return better than the FD return. Number two, there is a risk associated with my money. Also, because I have taken a lot of money, maybe from the banks, maybe from my friends, maybe from the market in order to start my business. So I would require a fairly large amount of return. Now, 8% is the FD rate. 2 to 3% will be my cost. Now I require 8 to 9% above it in order to in order to just overcome my cost, so that I can have a commanding position, I can have a lot of reserves with me, I can do lot more research in terms of my products, because I'll be sitting on a lot of cash when I'll be generating a lot of money. That's why I've taken the criteria as 20%. First cut is ROCE should be 20% for the last 4 years in continuation. Why last 4 years I have taken it? Firstly, why not 5 years or 10 years? When consider a small plant, a plant when it is 1 feet tall, a normal tree can grow up to say 200 feet or 100 feet tall. Consider a company. Consider a company that is already sitting on a valuation of 6 lakh crores. For example, we say TCS. It is sitting on 6 lakh crores. What are the what are the chances of that company going 100 times in next 10 years? The probabilities will be a little less because the size is huge. Now the tree has grown. When the tree has grown to its full length, only the bark increases. When the bark increases, consider the bark as the shareholders. That means more the number of shareholders, more profit will be divided among those shareholders. Less the bark, less the number of shareholders, the profit is going to get divided into less people. More, suppose profit is 50 rupees. Profit of 50 rupees is divided in 50 shareholders. Now my profit, since my size grew big, my profit became 100 rupees. My profit became 100 rupees, but now I have 200 shareholders. That means per shareholder, I am getting 100 by 200, that means zero point 0.5. That means per shareholder, the wealth decreases, and the amount of EPS increase, earning per share, is also reflected in the stock prices, which will be less. So I would always require to look at small companies with robust business models, which has huge upside potential with the probability of less downside risk. We got the point here clear of why 4 years. This 4 years I've explained here because it will help us a lot in the subsequent sessions when we talk about income growth, debt equity. We'll take up every concept very deeply. Here in the first session, we have considered ROCE, that is return on capital employed. I hope that you liked this. In the subsequent sessions, we'll talk about other ratios that we can consider while considering a company, while talking about any company. But this is the first and foremost ratio while considering any company. Hope you guys liked it. If you liked it, please share, like, or subscribe, and keep watching us Stock Simplified. Thank you.